Today, we look at one of the fastest growing economies in the ASEAN region, which is the Philippines. Indeed, the Philippine economy picked up to 5.7% in the first quarter of 2024, compared to the 5.5% growth seen in the previous quarter. The strong GDP growth in the first quarter was supported by improved exports. The contribution of net exports shifted to 1.2 percentage points from minus 1.4 percentage points, as exports, supported by higher electronics exports, rose by 7.5% year-on-year compared to a 2.5% contraction in the previous quarter. Meanwhile, domestic demand remained subdued relative to the previous quarter. There were some improvements in public sector spending, however, it was more than offset by slowing household and investment spending, reflecting the lagged impact of monetary policy tightening. The first quarter 2024 growth picture underscores the need for looser monetary and fiscal policies to boost domestic demand. Lower policy interest rates, easing inflationary pressures, and further progress on the government's structural reform agenda will help bolster household and investment spending in the coming quarters, in our view. Importantly, the bottoming out of the global electronics down cycle by the first half of 2024, in line with our house view, will allow for a more sustainable recovery of Philippines' electronics exports. Taken together, we expect these will support our full-year growth forecast of 6% for this year. In the medium term, we forecast the Philippine economy to grow by an average of 6% annually and to be sustained between 2024 to 2026. This will be supported by a focus on public infrastructure development, a realignment of FDI priorities, and solid household spending prospects. In terms of the fiscal profile, the government has revised higher its medium-term budget plan higher. We still expect the government will continue its fiscal consolidation, albeit at a slower pace than previously projected. The medium-term deficit will be pegged at the higher level of 3.7% of GDP in 2028 versus 3% of GDP previously. The recalibration will allow the government the fiscal space to support the implementation of its priorities aligned with the Philippine Development Plan for 2023 to 2028. And reflects a combination of lower revenue collections and higher expenditure until 2026. Beyond this, revenues and expenditures are lower compared to the previous plan. Inflationary pressures, which have been a bugbear for BSP since 2023, has shown signs of consistent easing. The government's decision to extend lower tariffs for key agricultural and energy products until 2028 to improve food and energy security, as well as lower oil prices, will likely continue to support the disinflation process. While the disinflation process has been bumpy and volatile, the first half of 2024 headline CPI has averaged 3.5% year-on-year compared to 6% in 2023. We see downside risks to our full-year 2024 forecast of 3.9%. Similarly, core inflation has averaged 3.4% year-on-year compared to 6.6% in 2023, mirroring some moderation in domestic demand pressures. So, what does this mean for monetary policy ahead? Well, we think the data is turning more favorable for the BSP to ease in the third quarter of 2024. This suggests that our baseline for the BSP to cut its policy rate by a cumulative 50 basis points starting in the fourth quarter of 2024 could be brought forward. However, the risk is that the BSP will need to stomach and handle depreciation pressures on the Philippine pesos.